10 things you should know about the cash flow statement. Number 1. Purpose. The cash flow statement, also known as the statement of cash flows, provides information about the cash inflows and outflows of a company during a specific period. It goes beyond the income statement and balance sheet to reveal how cash is generated and utilized within the organization. By presenting a clear breakdown of cash flows, this statement assists in assessing a company's liquidity, understanding its operating activities, and analyzing its investing and financing activities. It's a valuable tool for stockholders to gain insights into the company's cash position and its abilities to meet financial obligations. Number 2. Structure. The cash flow statement follows a structured format divided into 3 primary sections: operating activities, investing activities, and financing activities. This division allows for a systematic categorization of different types of cash flows, enabling a comprehensive understanding of the sources and uses of cash within the company. The operating activities section focuses on cash flows generated from core business operations. The investing activities section concentrates on cash flows related to investments in assets and other companies, while the financing activities section reveals cash flows linked to capital raises and financial obligations. This structure facilitates a holistic analysis of the company's cash management and utilization across various aspects of its operations. Number 3. Operating activities. The operating activities section of the cash flow statement provides a detailed overview of the cash flows that stem from the company's primary business operations. It encompasses cash received from customers for sales, interest or dividend income, as well as cash paid for expenses, suppliers, salaries, and taxes. By examining this section, analysts and investors can evaluate the company's abilities to generate cash from its core operations, which is crucial for sustaining day-to-day activities and funding future growth. Positive cash flow from operating activities indicates that the company's operations are generating sufficient cash to cover expenses and investments, while negative cash flow may raise concerns about the company's profitability or efficiency. Number 4. Investing activities. The investing activities section of the cash flow statement focuses on cash flows associated with the acquisition and sale of long-term assets and investments. This includes cash used for purchasing property, plant, and equipment, acquiring other companies, and investing in stocks or bonds. It also incorporates cash inflows from selling assets or receiving dividends from investments. By analyzing this section, investors and analysts can gain insight into the company's investment decisions and capital expenditures. Positive cash flow from investing activities suggests that the company is making prudent investments that may have the potential to generate future returns, while negative cash flow may indicate heavy capital expenditures or divestments. Number 5. Financing activities. The financing activities section of the cash flow statement provides a comprehensive view of cash flows related to the company's financing and capital structure. It encompasses cash received from issuing stocks or bonds, proceeds from loans or borrowings, as well as cash used for dividend payments, stock buybacks, or debt repayments. This section offers valuable insights into how the company raises capital, manages its financial obligations, and distributes cash to shareholders. Positive cash flow from financing activities indicates successful capital raising or debt management, while negative cash flow may signal excessive debt repayments or dividend distributions. Number 6. Operating cash flow. Operating cash flow is a crucial metric derived from the cash flow statement that represents the net cash generated or used by the company's operating activities. It serves as a key indicator of the company's ability to generate cash from its core operations. Positive operating cash flow demonstrates that the company's operational activities are generating sufficient cash to cover expenses and investments, indicating financial strength and sustainability. Conversely, negative operating cash flow suggests that the company may be relying on external financing or depleting its cash reserves to sustain its operations. Number 7. Free cash flow. Free cash flow is another important metric calculated based on the cash flow statement. It represents the cash available after covering capital expenditures required for maintaining or expanding the company's operations. Free cash flow serves as a measure of the company's abilities to generate cash that could be utilized for debt repayments, dividends, further investments, or other strategic initiatives like acquisitions. Positive free cash flow signals that the company has excess cash available for these purposes, indicating financial flexibility and potential for growth. On the other hand, negative free cash flow may indicate the need for external financing or a potential constraint on the company's ability to pursue growth opportunities. Number 8. Non-cash transactions. While the cash flow statement provides a comprehensive view of cash movement within the company, it does not capture non-cash transactions. Non-cash transactions such as depreciation, amortization, or stock-based compensation are essential for understanding the company's profitability and financial performance. However, they are not reflected in the cash flow statement according to GAAP accounting standards. Therefore, it is important to consider both the cash flow statement and other financial statements, such as the income statement and balance sheet, to obtain a complete picture of the company's financial performance. Number 9. Cash flow versus net income. It's important to differentiate between the cash flow statement and the reported net income of a company. While net income reflects the company's profitability, it includes non-cash items and changes in working capital that do not directly impact cash flows. The cash flow statement, on the other hand, focuses solely on cash transactions and provides insights into the actual movement of cash within the company. Therefore, analyzing the cash flow statement is crucial for understanding the company's liquidity, cash generating ability, and alignment between reported profits and actual cash flows. Number 10. Cash flow analysis. Analyzing the cash flow statement is an essential part of analyzing a company's financial health and evaluating its ability to generate and manage cash. It offers valuable information about the company's cash flow trends, sources, and uses of cash, as well as its effectiveness in cash management. By examining the cash flow statement, investors, analysts, and stakeholders can gain insight into the company's liquidity position, financial stability, and capacity to fund its operations and growth initiatives. This analysis assists in making informed investment decisions and understanding the company's overall financial performance and prospects. Of the 3 financial statements found on a Form 10-K, the cash flow statement is likely the most important. These are 10 things you should know about the cash flow statement. Comment below what else you should know, like the video if you enjoyed it, and subscribe to the channel for more financial education videos.